Sorry, just one more thought I wanted to end on here. The question might be, why would you have a debit balance in here from a previous period? The reason why you might have a debit balance in there from a previous period is if more people had defaulted than you had expected them to, okay? Because as people default, you debit, 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 and you might easily go beyond the $30,000 if it's a bad year for people and more people are defaulting than you expected them to. That's where you would see a debit balance in this account. Okay, let's move on to notes receivable. All right, notes receivable typically does not arise from your regular business like an accounts receivable does. Something has to happen to make a notes receivable happen. Whereas, like I said with my donut company, it's as simple as me delivering donuts to a grocery store and having them send me a bill. Or, I'm sorry, and me sending them a bill. That it gives rise to an accounts receivable. A notes receivable, on the other hand, is usually a more formal document. And usually there's an interest rate associated with it, there's a time period for payment, and it's just a more formal written agreement usually. So let's go through two of the occasions that you would have a note receivable arise. The first one is this slide. Received a $6,000 12% 30-day note dated November whatever in settlement of the account of W.A. Bunn. Alright, so what happened here was this W.A. Bunn owed us money. They owed us $6,000. And we had an account receivable set up for the $6,000. Let me put this in here. Okay, the account receivables balance from the previous slide was $6,000. So somebody owed us $6,000 as a regular old receivable, nothing special. And here's the thing, maybe they called us and said, hey, you know what, we can't pay you your $6,000. Can we pay it to you in 30 days and maybe we associate some interest with it too and I pay you some interest? And I say sure, because I like doing business with this particular company. They may have fallen on hard times and I've decided to allow their account receivable to become a note receivable. I mean, it's better that they do this and we work out this arrangement than if they just default altogether, right? So what I do is simply recategorize this. So what I'm going to do is I am going to debit notes receivables for $6,000 and credit accounts receivables for $6,000. And that's it. Okay? That's all I've done here in this journal entry. Debit a notes receivable, credit accounts receivable for the amount of the note. Okay, so let's talk about this note for a second. It's $6,000 at a 12% interest rate for 30 days. All right. Now, interest is always, always, always stated as an annual figure. So if this were an entire year, then it would be $6,000 at 12%. Okay, because that would be $720. But it's not for a year, it's for 30 days. So with that, you have to calculate that slightly differently. All right, I always like to tell my students that interest is calculated no matter what class you're in as principal times interest, meaning the interest rate, times time. Okay, so in this case, it's $6,000 times 12% times, and because it's 30 days out of a year, we're going to make it simple, and we're going to say 30 days is 1/12 of the year. Okay, and that is going to equate to $60. All right. So we're looking at $60 worth of interest is going to build up on this note that we're going to be paid. All right. So now that we've calculated the interest, let's move forward. On December 21st, when the note matures, the firm receives $6,060. All right. So the cash we're going to get is going to be the $6,060. Right. The $6,000 of the note, $60 worth of interest that we just calculated. We're going to take the note receivable off of the books. We're going to credit it. And the other thing we're going to record is something that you haven't seen before in action is interest revenue. All right, we basically loan them money, and we by letting them use that money, that $6,000 for an extra month. So with that, the interest that we earned on that is going to be interest revenue to us, and will be in the income statement in the other section. And the reason it would wind up in the income statement is the other income section below operations and such, is because we're not in business to loan money. We're in business, in my example anyway, to make donuts. So this interest revenue, this extra $60 that we made, is really other income because it's not part of my core business activities. Okay, moving on. Okay, the other way a note can arise is if you're just loaning somebody some money. Okay, a note receivable, or you're borrowing money from the bank or something, or well, the bank wouldn't really be borrowing money from you, I hope. But let's just say that somebody's borrowing money from us. So we have a notes receivable. So don't worry about, an accounts receivable turning into notes receivable. Or maybe, how about this, one better. How about somebody's buying something from us, and we're going to issue a note receivable for the amount of money that's due to us, because they can't pay us, it's not an account receivable, we don't normally sell the equipment, we're going to issue a note instead, all right? And they're going to pay us some amount of interest. So when that happens, your journal entry is just a debit to note receivable, and maybe a credit to sales revenue for the amount of the receivable. So let's see, I didn't think of an amount. Let's say we're talking about $10,000. And the sales revenue is because we sold something. All right, well, let's do this. Let's sell a piece of equipment. Okay, we're not going to worry about depreciation, all that stuff. Save that for the next chapter. But let's just say we sold a piece of equipment for $10,000, okay? So here we are, we're holding the note, and maybe we told them that we would pay them, well, okay, let's put the numbers in here. Let's say the principal amount is $10,000, which is the amount the note is for, and let's say that we told them we would do it at a 12% interest rate, which is obscenely high, even though, all right, well, 12% interest rate. And they're going to pay us, let's say, in 6 months, okay? So if they're going to pay us in 6 months, that's going to be 6/12 for your time, because it's going to be 6 months out of the year. So $10,000, I'm multiplying it here on my calculator, which is ridiculous that I'm doing this, but $10,000, hang on a second. All right, you multiply this out, and you have $600. Oops, not 6,000. So when they do go to pay you for the note, the journal entry is pretty easy. The cash you're getting is not $10,000, but $10,600. You would take your note receivable off the books. Goodbye, note receivable for $10,000. And the other part to make your entry balance is something we just talked about, interest revenue for the $600. And that's really the basis for recording a note receivable. Okay, so I hope you've gotten a bunch out of this chapter, and I'll see you for the next one.